Shanghai fixed silver at the equivalent of $71.57 per ounce on December 22, 2025. New York quoted $69. That gap, $2.57, represents something far more dangerous than a pricing error. In a functioning market, arbitrage eliminates these spreads within seconds. Banks buy cheap metal in one location, ship it, sell it where prices are higher, pocket the difference. It's automatic. It's mechanical. It keeps global prices synchronized. But today, the synchronization is broken. The gap sits there, wide open, screaming at anyone paying attention. The question isn't why the spread exists. The question is why nobody is closing it. The answer cuts through every assumption about how commodity markets operate. Western banks cannot source the physical metal to execute the arbitrage. The silver trading at $69 in New York exists primarily on screens, in contracts, in ledgers, but not in vaults. You can purchase the paper contract, but attempt to demand delivery of 1,000 bars and load them onto a plane bound for China. You will discover the metal simply is not available. This is where the entire pricing mechanism begins to fracture. What began as a technical divergence between paper and physical markets has metastasized into a supply chain rupture. Major U.S. bullion dealers, JM Bullion, APMEX, SD Bullion, are displaying out-of-stock notices across their entire inventory of 1 kilogram silver bars. Not just low stock, not just delayed shipping. 24 different types of kilo bars completely unavailable. Sunshine Minting, Valcambi Swiss, Pamp Swiss, Silvertown, all gone. These are not boutique collectibles. These are the standard industrial units that serious institutional buyers and retail investors rely upon. When these disappear simultaneously across multiple dealers, it signals a run on available supply. The timing matters. Over the weekend, when information about China's January 1st export lockdown leaked into market channels, sophisticated buyers did not wait for Monday morning announcements. They went online immediately and cleared out accessible inventory. The dealers are now posting ship dates in mid-January, some extending into February. This means they are selling metal they do not currently possess, metal they hope to receive from refiners, who are themselves declaring force majeure. The entire supply chain is operating on promises rather than physical delivery. Mexico produces more silver than any other nation on Earth. If Mexican supply chains rupture, the game changes entirely. Letters have been circulating from Fresnillo plc, one of Mexico's largest silver producers, invoking force majeure clauses in contracts with U.S. refiners. The justification cites two specific triggers: critical supply chain disruptions due to inability to source precursor chemicals from China following the new export ban, and regional labor instability. A diplomatic way of describing miners who realize the metal they extract is worth $71, while their compensation remains anchored to a $60 price environment. This is the cascading failure pattern. China bans exports on January 1st. U.S. refiners lose access to semi-processed materials they source from China. Mexican mines cannot obtain the chemicals they need from U.S. refiners. Production halts. Force majeure gets declared. The U.S. Mint stops receiving silver blanks. Apple cannot source silver contacts for devices. Individual buyers cannot purchase bars from dealers. The pipeline has run dry, not because of demand destruction, but because of supply sequestration. If you work in industrial procurement or metals trading, you are likely watching similar disruptions unfold in your sector right now. Write in the comments what you are observing on the ground. Are your suppliers still delivering on schedule? Or are you seeing delays and allocation notices that were not there 3 months ago? The lease rate for silver tells you everything about vault availability. In normal market conditions, this rate hovers near 0.5% or 1%. Banks hold so much silver in London vaults that they lend it to each other for almost nothing, just to generate minimal interest. But on the morning of December 22nd, the 1-month silver lease rate spiked to 32% annualized. This is not tightness. This is a mathematical scream. It means any bank attempting to borrow silver for 1 month to cover a short position must pay an annualized interest rate of 32%. Historically, lease rates only behave this way when vaults are empty. It happened briefly in 2020. It happened in 1998 when Warren Buffett acquired 130 million ounces. But a 32% spike represents the banking equivalent of cardiac arrest. It confirms one undeniable reality: there is no metal available to borrow. Backwardation has entered the market structure. Normally, silver for delivery next year should trade at a premium to silver today because of storage costs, insurance, and interest. That is called contango, the healthy state of a functioning futures market. But today, spot silver trades at a $2.88 premium over futures contracts. This is the largest backwardation spread since 1980. The market is shouting that it does not want paper promises for next year. It wants physical metal now. Traders are paying a massive premium, almost $3 per ounce, to receive bars immediately rather than waiting for futures contract maturity. This destroys short sellers. If you sell short, you depend on futures prices exceeding spot prices. You sell high, buy back low. But in backwardation, you sell low and are forced to buy high. Every day you maintain that position, you hemorrhage cash. With lease rates at 32%, the cost of holding becomes unbearable. The shorts are caught in a three-sided vice. First, price. Shanghai gaps to $71. Second, cost. The lease rate hits 32%. Third, structure. The backwardation penalty extracts $2.88 per ounce. There is no escape route. The only exit is to buy back the position, but that requires finding a seller. The sellers have declared force majeure. The algorithms that have controlled silver for 20 years have reversed. For 2 decades, high-frequency trading bots owned by bullion banks have been programmed with a single directive: sell into strength. Whenever silver climbed above a key moving average or threatened a breakout, these bots executed thousands of sell orders in milliseconds, creating artificial supply walls. It worked in 2011. It worked in 2020. But at 10:42 a.m. EST on December 22nd, a massive block of buy orders hit the COMEX. These were not human orders. They were too fast, too precise. They were machine orders, but they were not selling into the rally. They were chasing it. Why would the bank's own machines turn against them? Because algorithms do not have loyalty. They have math. When silver gapped over $68.40, it broke a 20-year resistance line. The algorithms that use mean reversion models, models that assume what goes up must come down, encountered a statistical anomaly their programming could not process. Their error correction protocols crashed. Secondary momentum ignition protocols activated. The code essentially says, if price exceeds $68, volume exceeds 10 times average, and the Shanghai spread reaches $2 or more, buy everything. The very machines that suppressed silver for decades are now locked in a feedback loop of buying, competing with each other to acquire contracts before the price hits $75. Because there are no human sellers, the miners declared force majeure. The machines are bidding against a vacuum. This is what a liquidity black hole looks like. Price can move from $69 to $72 in a single tick because there are zero sell orders between those levels. At 1 p.m. EST, the buying pressure became so overwhelming that silver futures locked limit up at $69.50. There are currently 14,000 contracts sitting on the bid side at that price. That represents 70 million ounces of demand that wants to buy but cannot find a single seller. Not one. The ask side is empty. While New York is frozen at $69.50, the gray market bid in Singapore is crossing $72. The gap between the frozen price and the real price is now $2.50. Tomorrow morning, when the COMEX reopens, the limit resets. The price will instantly gap up another $3. It will likely open at $72.50 and lock limit up again within minutes. Do you remember what happened with nickel on the London Metal Exchange in March 2022? A Chinese tycoon named Big Shot was short massive amounts of nickel. The price exploded. He faced billions in margin calls and bankruptcy. The banks that lent to him were also facing insolvency. So what did the LME do? They shut down the market for a week. Then, they retroactively canceled trades. They looked at the people who bought nickel, the ones who made the correct call and earned fortunes, and told them those trades never happened. The exchange deleted them to save the banks. They stole billions from winners to bail out losers. Here's the uncomfortable question. Will the COMEX execute a nickel-style intervention on silver if the price hits $100 this week? If foreign banks holding short positions of 215 million ounces face insolvency? If JP Morgan determines systemic risk is present, do you think they will allow you to keep your profits? If you own a futures contract, you are playing in their casino. If the house loses too much money, the house can kick you out and keep your chips. They can declare disorderly market conditions. They can void your trades. They can force cash settlement at a price they decide, probably $65 or $70, while real metal trades at $100. Which interpretation makes more sense to you? Is this a temporary dislocation that will resolve once liquidity returns? Or are we watching a permanent structural break where paper and physical markets decouple entirely? Write your view in the comments. Rumors are circulating in Dubai and Singapore about Project Sandstorm. The rumor suggests a consortium of sovereign wealth funds, likely from Gulf states and Southeast Asia, has decided to diversify out of US dollars and into strategic hard assets. They are not just buying gold anymore. They are buying silver, but not 1,000-ounce bars from dealers. They are buying 10-year offtake agreements. They are approaching major producers in Poland, Mexico, and Peru directly and saying, "We will purchase 100% of your production for the next decade. Here is $5 billion cash up front." This bypasses the COMEX entirely. It removes supply from the market before it ever reaches a vault. If this rumor is accurate, and the force majeure letters from Mexico suggest it is, then the COMEX is fighting a war over an empty pile. The real silver has already been sold forward. It has been privatized by nations that understand the value of energy metals. China produced over 400 gigawatts of solar panels this year. The shift to N-type TOPCon solar cells has increased silver consumption by 30 to 50% per panel. 400 gigawatts multiplied by roughly 15 to 20 million ounces per 100 gigawatts for N-type technology equals 60 to 80 million ounces of additional demand just from the technology switch. That is why they banned exports. They are not attempting to squeeze Western markets. They are trying to keep their solar factories operational. They examined their warehouses and saw the bottom. They realized that if they allowed silver to leave the country, their solar production would shut down. Since solar is the backbone of their energy independent strategy, that is unacceptable. The $71 price in Shanghai is not a financial number. It is a survival bid. It is Chinese industry saying, "We will pay whatever it takes, just deliver the metal." China has the cash. China has the trade surplus. China has the ports. The US Mint has a budget. It has statutory limits on what it can pay for blanks. If the US Mint can only pay spot plus $2, and China is paying spot plus $5, where does the silver from Mexico go? It goes onto a ship in Manzanillo and heads west across the Pacific. It never touches American soil. Even mainstream analysts, who usually maintain conservative positions on silver, are capitulating. MKS Pampa Global recently stated that silver's rally is being driven by tight physical supply in London and China, with expectations to rise into the $70 to $80 range by March. They are acknowledging the squeeze is real. If analysts are bullish based on data from last month, data that showed exports still flowing, imagine how bullish they will become when they realize supply from China has been cut to zero. Goldman Sachs rumors are circulating. UBS is targeting $55 by mid-2026, which is already absurdly low, given we are at $69. Bank of America is calling for $65 by 2026. We blew past their 2026 targets this morning. This tells you the smart money is behind the curve. They are using models from 2020. They are modeling a market with elastic supply. They do not have a model for zero exports. They do not have a model for force majeure. When the models break, analysts panic. When analysts panic, they issue buy ratings to cover themselves. Have you noticed silver premiums widening at your local dealer or on online platforms? If you have recently tried to purchase physical silver, what kind of premiums and wait times were you quoted? Share the numbers you are seeing in the comments. The technology sector has not yet reacted publicly, but procurement officers at Apple, Tesla, Samsung, and Microsoft are sweating. These companies sit on trillions of dollars in cash, but their entire business model depends on silver. You cannot manufacture an iPhone without silver. You cannot build a Tesla without silver. Right now, they operate on just-in-time delivery. They do not maintain massive warehouses of silver. They trust the supply chain. The supply chain broke this morning. What happens when Tim Cook realizes he might not be able to build the iPhone 17 because China will not export silver paste? Apple has $200 billion in cash. The entire annual production of silver is worth roughly $25 billion at old prices. Apple could buy the entire global mine supply of silver for 8 years with the cash they have in the bank. If a single tech giant decides to panic buy, if Elon Musk decides to secure a strategic reserve for Tesla, the price does not go to $100. It goes to a number that makes no sense. We are watching a game of chicken between bank shorts and industry longs. The banks have algorithms. Industry has actual need. Industry wins every time because you cannot print silver. Global annual production, 840 million ounces. Global annual demand, industrial plus investment, 1.2 billion ounces. Structural deficit, 360 million ounces. That was the old math before the ban. The new math post-January 1st. China traps 15% of supply, approximately 126 million ounces. Force majeure in Mexico traps another 10%, approximately 80 million ounces. Available supply for the West, 634 million ounces. Demand, 800 million ounces. New deficit, 166 million ounces in the West alone. But here's the critical impossibility. The short position held by foreign banks is 215 million ounces. The banks need to buy back 215 million ounces to close their shorts, but the entire available deficit in the West is creating a hole of 166 million ounces. There is literally not enough silver in the Western Hemisphere to cover the short position. Even if they purchased every single ounce mined in Peru, Mexico, and the US, they would still be short. This is a mathematical impossibility. When a market hits a mathematical impossibility, price goes to infinity. Or more accurately, price goes to the level where people start melting down their grandmother's tea sets. If you are holding silver right now, do you see this as a moment to take profits and rotate into other assets? Or are you viewing this as a paradigm shift where selling physical metal at any price in fiat currency would be a strategic mistake? What is your personal threshold and why? Respond in the comments. There is a specific refinery manager in North America, we will call him Source Alpha to protect his identity, who told us the phone has not stopped ringing since 4 a.m. Automakers, battery manufacturers, mints, they are all asking the same thing. How much 1,000-ounce bar inventory do you have? He had to tell them the truth. 0. They are currently melting 100-ounce retail bars just to fulfill industrial orders. They are cannibalizing the retail market to feed the industrial beast. He has been in the business for 30 years. He saw 2011. He saw 1980. He said this is different. In 1980, people lined up around the block to sell silver. Today, nobody is selling. The public is not bringing in scrap. They are hoarding. This confirms the shadow inventory theory. Usually when prices spike, secondary supply hits the market. People melt down tea sets, but at $70, it is not happening. Why? Because people are scared. They read headlines about China. They see banks failing. They see inflation. They are not thinking about profit. They are thinking about preservation. The psychological shift from greed to fear removes secondary supply from the market. Without that buffer, there's no shock absorber. The plunge protection team reportedly held an emergency meeting at 2:30 p.m. on December 22nd. The topic: market disorder in strategic metals. They have 3 options. Option 1, do nothing. Let the market clear. Let the price go to $100. Let foreign banks fail. Risk destroys confidence in the banking system and hands a massive geopolitical win to China. Option 2, margin hike. The CME group could raise margin requirements to 100% overnight to force longs to sell because they cannot afford the margin. Problem: the longs right now are not speculators. They are industrial users and sovereign wealth funds. They have cash. They are not trading on margin. You can raise margin to 100%. They will just pay it. Option 3, the nuclear option. Exchange holiday. Close the COMEX for a cool down period. Risk: this creates a black market instantly. If you close the exchange, Toyota and Samsung still need silver. They will just buy it privately at $100. The COMEX becomes irrelevant. Prediction: they will try option 2 tonight. Expect a notice from the CME raising margins. It will not work. The buyers are too strong. Later this week, they might try option 3. If the exchange closes, God help anyone holding paper. For 45 years, the price of silver was a lie. It was a lie managed by paper contracts. It was a lie enforced by high-frequency trading. It was a lie agreed upon by central banks to preserve the illusion of fiat currency stability. On Monday, December 22nd, 2025, the lie died. The truth is that silver is rare. The truth is that silver is essential. The truth is that there is not enough of it to go around. When truth breaks free from the chains of manipulation, it does not act politely. It explodes. We are witnessing the revaluation of the world's most suppressed asset in real time. Wealth is transferring from the paper class to the physical class. If you stacked when it was boring, if you held when they smashed it, you won. You did not just make money. You preserved labor. You opted out of their system and built your own life raft. The storm is not over. It is just beginning. The volatility in the next few weeks will test resolve. You will see $80. You might see a crash back to $60, then a rocket to 100. They will try to shake you out. Remember the fundamentals. Remember force majeure. Remember Shanghai at 71. The genie is out of the bottle. He is not going back in. If you believe this breakdown accurately reflects what is happening, or if you think there are critical blind spots in this analysis, write your perspective in the comments. What signal or data point do you think matters most right now that is not getting enough attention?